But another set of earnings, and we have with us Dr. Ashutosh Raghuvanshi from Fortis Healthcare joining in on the show right now. Dr. Raghuvanshi, in hospitals, most of the key operating metrics have shown a positive movement. Tell us a little bit about the strong growth that one is seeing.
Hospital business specifically in this quarter saw a recovery from the previous year's lows. And this was essentially on the backing of a larger number of surgical patients. So both the occupancy levels had also come towards normal. And at the same time, the ARPOB levels were also significantly higher. And that was because of the patient mix and higher number of surgical cases. And we are seeing that occupancy trend continuing going forward as well. So in many ways, I can say that the non-COVID business has recovered significantly. Another highlight of the quarter was that the international business also seems to be creeping towards near normal, at the pre-pandemic levels. So with all these factors coming together, I think the hospital business is definitely on an upswing.
Right. Dr. Raghuvanshi, your average revenue per bed stood at an all-time high of about 1.96 crore rupees, and I understand that's a mammoth uptick of about 25%. Do you think this can hold, and can you maintain these levels?
Yes, as far as hospitals are concerned, we should actually see an improvement because we're expecting occupancy levels to improve. We have also added few beds, not a very large number, but we have added about 60 beds. And on the higher bed base, we are likely to see a higher occupancy than what we have seen so far. And that certainly would help us to achieve these financial metrics.
Now, surgical revenue contributed to 61% of the total revenue. Typically, surgical revenue contribution is 55%. Is there a demand pickup? Will it continue?
There is a little bit of pent-up demand. We have seen in a couple of specialties, especially in orthopedic joint replacements, where the numbers have been extraordinarily high, all-time high in practically all the hospitals. So that part may come down. However, as far as all other specialties are concerned, we are only seeing a kind of a normal growth pattern. So that will be sustainable. I would say that little bit of ratio will change towards the medical versus surgical. But overall, I think these numbers are here to stay.
So 31%, probably 30% of the operating beds have recorded an EBITDA margin of 25%. What does that compare with only 12% operating beds at delivering 25% EBITDA margin in FY20? Do you think cost saving plus price rise will change this?
Yes. So there are certain clusters and certain hospitals which have performed well, which were historically not doing that great. So there has been a shift. So majority of our beds today, other than 2 or 3 assets, are in the range of at least 10 to 15% EBITDA or higher. So I think this is just a function of growth. Occupancy levels have improved. And the NCR level, if we have to see the NCR cluster, we always find that there the EBITDA levels have remained typically above 20%. So we saw a little higher occupancy in these areas, and that led to a higher contribution from there.
Dr. Raghuvanshi, good morning. Can we also talk about the diagnostics business, in the post-COVID world? Has that started to normalize? This is also a space where we are seeing a price war of sorts, intensified competition, costs of tests have been coming down.
The diagnostic business this quarter, as you would have seen with the numbers, has been little muted, and that was on expected lines. So the revenues were impacted essentially because in the earlier quarters in last year, we got some bump up from the tailwinds from COVID business. So like in the first quarter, there was about 25% of the revenue came from COVID tests. Whereas in the fourth quarter, about 11% of the revenue came from the test, and that has gone. However, on the organic basis, if we see the non-COVID tests, they have grown only at about 5%. So you're right, the competitive intensity is more, and the industry is seeing a lot of new players coming in, and that is certainly putting some pressure on all the players. One of the points which I would like to highlight here is that the new age models are essentially going for deep discounting, and that I think is a phenomena which is not going to be there for very long time. So this will stabilize, and the legacy players would definitely be able to consolidate further within the industry, because there's a lot of unorganized sector all across the country. And I think with that, we feel that the position of our diagnostic business is pretty secure. Though we may not see that kind of growth as was seen in the past, margins also are likely to be under pressure because there is a competitive pressure on the pricing as well.
Okay, so deep discounting in the diagnostics is not going to continue. So from that point, Fortis is secure. But Dr. Raghuvanshi, what about the higher costs that is there for the patients at the hospitals? Those costs have also gone up. How are they reacting, and what has been the impact of that on business?
Yeah, one of the major things which we have seen post-pandemic is that the penetration of insurance has increased. So the TPA segment is definitely becoming bigger than what it used to be, and that itself is a change which will be there. And the impact of that could be that the pricing may come under a little bit of pressure, because the bargaining power for the insurance would be much higher in future. So that is one significant change which we are seeing. The other change, which is a very positive change in my view for the community, is that the hospitals in secondary towns, etc., have started doing better, and that's a good thing overall for the industry.
Okay, Dr. Raghuvanshi, we're going to leave it at that. Thank you so much for joining us today, taking us to the fine print of the earnings and, of course, the road ahead, the stock trading higher and over by about 1.5%.